What is your thought process around term insurance and proper frameworks on how to think about term
Yeah,
insurance?
I've come a long way on term. And I think people give term way too much credit. So let me even take a step back and say, what is life insurance? Well, life insurance fundamentally is a way to levelize a non-level cost. So think about this. If you had a group of people, 100 people or whatever, 1,000 people, and they said, hey, we're gonna self-insure. We don't need an insurance company. We're gonna self-insure. Here's how it's gonna work. Person, we're gonna be 1,000 people in this group. One person dies. We're gonna pay out $100,000, let's say. Okay, that $100,000 benefit to the family of the person who died is then shared by the people in the group. And so you get a bill at the end of the year that basically says, hey, Bill died. We paid his family this money. You have a bill to pay your part of that money. That works great when the group is small. When the group is young and it's early on in the life of the contract. As time progresses, two things happen. Number one, more people die because you're getting older. And so every year the cost of being in the group goes up if you're one of the survivors. And so that's natural, right? As we get older, the likelihood of death is higher. And so we have this nonlinear sort of cost spread going on. And then the second thing that happens is there are fewer people to spread the cost over. And so you have these two nonlinear elements going on. So what does life insurance do? Life insurance says, well, wait a second, it doesn't make any sense to be in one of these groups. And these groups actually existed prior to life insurance companies existing. And the problem is they all break up at some point. They kick the unhealthy people out. The healthy people all band back together and they create a new group. That's not life insurance. That's a temporary. That's effectively term insurance. That's temporary benefit, and then the group breaks up, and the healthy people go form a new group, and the unhealthy people don't have any coverage. So what's the goal of life insurance? Life insurance says, all right, we've got this mortality cost that's increasing. We're going to flatten that out. And so the way you're going to flatten it out is everyone is going to overpay early relative to their actual mortality cost, so that they can underpay late. And so if the curve is upward sloping, we're basically just going to draw a line right through the middle of that curve, and you're going to overpay early so that you can underpay late. And that way, everybody can stay in the group at the same cost every year, and they can get the coverage that they need. And that's every single life insurance policy effectively works that way. Whole life does that leveling function over the entire, till you're age 121, right? There's no way for that policy to lapse. And so we're levelizing effectively the entire mortality slope with a whole life premium. So let's just say that costs $10,000. So you're paying $10,000. Let's say the mortality incidence in the first year is $10. Where does the extra money go? Well, the money goes into a reserve that earns interest so that later on, when the mortality claims are higher, you have money there to pay those claims while everyone pays the level premium. Does that make sense?
Yes.
All right.
Yeah.
Now, then people look at it and say, well, $10,000 is a lot of money. Oh, man. That's right. Because we're levelizing the entire mortality curve all the way out to 120. You are going to die. The question is, do you want life insurance when you die or not? Right. And if the answer is yes, I do, then you have to levelize that cost over the entire curve. If you don't, then the cost of paying the incremental mortality cost every year is going to end up being several times what you actually get back in the death benefit. And so you have to levelize the cost in order to make this work if you're thinking long term, if you're thinking about age 90, age 95, age 100. So what happens is people say, well, whole life is very expensive. That's why I do term insurance. Okay, well, let's talk about term insurance. What does term insurance do? Term insurance levelizes the cost of mortality, the same cost, by the way, whether it's in whole life or term. It simply levelizes that cost over a shorter period of time.
That's right.
And so if you think about the average, just simple math here, the average of the full slope to age 121 is obviously a lot higher than the average of the next 10 years of mortality, especially on like a 35-year-old. And so if we go back to the example, if mortality costs $10 in the first year and you're 35 years old, maybe on average over the next 20 years, it costs $300 or $400. And so then you run the comparison and you say, well, whole life costs $10,000. Term insurance costs $400. Why would I not go with the cheaper product? Well, they're actually the exact same policy. They're both levelizing the cost over a specific period of time. So the reason why term insurance is cheaper is because it doesn't pay very many claims. So the value is less. So this is a perfect example of where the narrative in the popular press is whole life is expensive because of agent commissions and blah, blah, blah. Yeah. We'll talk about that in a minute. The real issue with whole life is that it and any permanent life insurance policy is you're levelizing costs over the entire span of mortality. Term is just a shorter span. Term is cheaper because you are less likely to die with it.
Right.
So it's not inherently better or worse than whole life. It's simply taking a temporary view of mortality, which leads to the following question, which is, okay, what is your mortality liability? And for some people, they say, I don't have any need for life insurance after age 65. Okay, maybe. I've met very few people at 65 who feel that way, because most people at 65 have kids, they have grandkids, maybe they work longer than they should, maybe they still have a mortgage. People, they want to leave a legacy to their family. I mean, there's all kinds of reasons why. Or let's imagine another scenario: they've become uninsurable, and they're now realizing, gosh, I really would like some life insurance to replenish, for example, all the money that I've spent on medical care. All these things, all these reasons. So very, very few people at 65 actually wake up and say, today's the day I no longer need my $5 million or $3 million term life insurance policy. I'm just going to let it drop. Mm-hmm. So it's very short-term thinking for a 35-year-old to think, I know that in 30 years, I'm not going to need life insurance. There's a whole lot of life that happens in 35 years. And the problem is term insurance does not prepare you for that. Term insurance does not give you that opportunity, because what term insurance does is it says, okay, you're going to get coverage for 35 years. Let's say that you need it one day past the end of the term period. What happens? Well, then you pay these exorbitantly high costs. Yeah. And so the dirty little secret in our industry is that we are a little bit, term insurance is a little bit like the sort of notorious printer versus ink example, right? The printer company loses money selling the printer, but they make money on the ink. So it's kind of counterintuitive thing. People think life insurance companies make money on term insurance. No, they do not. It's a loss leader. Where they make money is when people who still need coverage get to the end of the term and have to pay rates that are 3, 4, 5, 6 times what they would have had to pay had they just bought permanent insurance to begin with. And those people effectively are where the carrier makes all their money. And so if you know you're not going to be that person, you say, well, that sounds like a pretty good deal. You don't know if you're not going to be that person. So that's one option. So if you want to keep your term coverage, you're going to end up paying way higher rates than if you just bought permanent at the onset. The other option is to go through and say, you know what, I actually do need coverage past 65. And so what then do we offer people? We offer people the ability to convert their term insurance to permanent insurance. So the solution for long-term insurance needs is always permanent insurance. The out, if you need to get the out at the end of a term policy, is to convert to permanent insurance. So the question is, well, why didn't you buy permanent insurance to begin with? Well, because it was expensive. Well, yeah, because it covers your entire life. So let's get back to this commissions point. So the commissions point on this, I think, is really interesting. The commissions point is correct in that the total dollar amount of commission on term insurance is lower than on permanent insurance because the premiums are lower. So typical commission payouts, let's just say, are 100% of premium paid. That's 100% of the term premium and 100% of the whole life premium. So the commission rate is actually usually significantly higher on term insurance in the real world than it is even on whole life. It's just that the premiums are so much cheaper. So when someone says, oh, term's a low commission product. No. Again, it's a low premium product. It's a low value product. And that is why it's a low commission product in terms of dollars, but it's a very high commission rate. Whole life is a high value, higher premium product, and it actually pays commissions at a lower rate than term insurance. Oh, and by the way, if you convert your term insurance to a permanent policy, guess what the agent gets? A full commission on a permanent policy. And so a lot of times agents sell term so they can make 2 commissions rather than 1 commission. And because you're waiting a few years for the permanent policy to kick in, the commission on the new permanent policy for the conversion is higher than what they would have made at the beginning. And so there is this sales strategy out there saying, hey, sell term to get them in the door and then convert it later, and you're actually going to make more money down the road. So I say all this, I've been on the soapbox. Let me round out with this comment and say term insurance is for a very particular fact pattern. If you are 100% confident without a doubt that you do not need life insurance beyond the end of the term period, then just pay for what you need. I would argue that effectively nobody is 100% sure. Period. End of story. So you got to realize when you're doing term, when you buy a term policy, you are taking risk. You are punting that issue down the road. You are effectively making a decision as a 35-year-old that you might really regret as a 65-year-old. And you're setting yourself up for that situation where you have no other options. And a lot of companies, by the way, don't even offer conversions in their term policies, and people don't even know it. They don't even read the language in their contract. So if you're in one of those contracts, you're stuck. If you become uninsurable, you're stuck. If you don't convert within the window and you miss the window and you hold it to the end, you're stuck. So again, mental framework here. Term insurance is a decision that feels good at 35 and feels terrible at 55 for a lot of people. As a financial planner, speaking of financial planners now, as a financial planner, your entire job is to get 35-year-olds to make decisions that they will appreciate at 55 and 65.
That's good.
Right? Is that not the entire financial planning profession in a nutshell?
That's really, really well said. Is our job is to look back 10, 15, 20, 30, 40, 50 years and have the client say thank you.
Exactly.
And in a lot of cases, you're not going to be their best friend. I almost think of parenting.
Right.
Like
right.
you want to parent well. Your kid may not love you today,
Yeah.
but hopefully the hope is when they're older, they'll look back and say thank you because I am a better human being because you did the right thing, not just the popular thing.
That is an even better analogy. That is the best. I mean, we both have kids now. That's the best analogy you can come up with. Yeah. Because your kids are going to be mad at you actually when they're, my kids are 9, 7, and 5. They're mad at me when I tell them no for something they're going to appreciate when they're 17 and 19 and 20 or whatever it is. Same dynamic goes here. So the question is, okay, well, in what situation would a client be thanking an advisor 15, 20 years from now? It's when they paid more to satisfy a long-term need. And again, I mean, it's getting 35-year-olds to make decisions their 65-year-olds selves will appreciate. That's why we use 529 plans. That's why we use supplemental retirement plans. That's why we set aside savings. And that's also why people should buy permanent insurance. And I think that's the logic.
Let me play devil's advocate here. So you're right. You're right now. You're not talking about overfunding. You're talking purely death benefit, which in the future, and we're going to talk about whole life in a second about how that can be a retirement asset. And there's been a lot of research out there. So I'm excited about diving into that. But we're talking about like just the death benefit standpoint. Let's say you're watching this or listening to this and you're like, okay, are you telling me that if like money is not, I don't have a ton of money watching this. You're saying that would I be better off like getting my insurance need all in like permanent life insurance and not investing? Or is there a combination where I can potentially do a combination of both? Because it's like, it's one thing to say it, but it's another thing to be like, and again, you're not giving financial advice. Don't sue Bobby or I, but like, would you say like get your insurance knocked out and do it all on the permanent side before you even look at investing? Or is there a framework of like, okay, 50-50, invest 50, put 50 in insurance? Because is my question making sense? It's like, where do you draw the line? Because it might sound really good, but I don't think what you're saying potentially is saying, okay, don't invest at all, put all your money in like a whole life insurance base contract. You'll thank me in the long run. Ironically, you may be better off 30 years from now just based on human behavior, but I'm not saying that that's what you're saying.
No, I would even phrase it this way. I gave the generality here. If you're choosing between investing and life insurance, don't put all your money in life insurance. Period. End of story. I think what I'm saying more is the higher level point, which is recognize that buying term insurance entails risk. And so you're going to take risk on your investments. The risk here is that you actually need life insurance for a variety of reasons you may not even know or understand right now. And that by buying term insurance, you're excluding that possibility down the road. Now, here's the issue, Caleb. This is where our industry does a crappy job. Right now, the price comparison is $400 for term, $10,000 for whole life. There's a huge gradient in between. And one of the things I like about universal life is that it's a flexible premium product. Theoretically, you could fund it with a term insurance premium, but actually have a permanent policy. And as you have more capacity to save, you can increase the amount of your savings. I would argue a whole life policy with a heavy term blend can kind of get you to a similar spot. That's flexibility. That's optionality. That preserves future choice. That does not require that you convert the policy. So what I'd say is don't think about whole life all base versus term. If you can't afford whole life all base or any other policy that you're really thinking long term, and we're going to talk about the accumulation attributes to your point in a minute, but just for your protection, there's a whole spectrum in between. Our industry has not done a good job of providing options that really fall in between in a way that a customer would want. What a customer would want is a policy where they pay the term premium and they get coverage for that period of time, and they have the option to pay more. And as they pay more, they can basically pre-fund a future extension of their policy on reasonable terms.
Yeah.
The problem with our industry is we agents want full compensation for permanent. There's kind of a permanent compensation premium amount, and then there's a term. What we should be able to do is have term premiums, term products that pay term comp, and permanent policies that pay term comp. And if the client chooses to pay more, then we pay comp on what the client pays more on, because the agent's probably calling them back and saying, hey, you should put more money into this thing. Those products don't really exist. Now, I'm happy to say I am the newsletter editor that you kind of know about. I also run a product development company. And one of the things we are doing is working with 2 insurers right now to build out products like this so that customers can go in and say, you know what, I need protection today. Yeah. I know that in the future, I'm going to be able to save more. And I want to be able to do that all on one chassis. I want my agent to be paid fairly. I want my policy charges to make sense. And that's the kind of product the customer wants. And again, I think as an industry, we've done a crappy job of giving that to them. If you're really high net worth and you've got lots of discretionary savings, we've got a million products for you.
Yeah.
If you just want the cheapest thing out there, even if it's not very valuable, like term insurance, we got a million products out there. Most people don't fall into those buckets, right? They want optionality, they want flexibility. And I think as an industry, we need to get better at giving that to them.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.